stock is up 65% this year. It's not Nvidia, it's not AMD. This company makes the machines that build the chips. The company is Applied Materials, ticker AMAT, just reported earnings after market close and beat on every single line. Revenue $7.91 billion versus $7.68 billion expected. Earnings per share at $2.86 versus $2.68 expected. Shares jumped more than 5% in after hours, but the guidance is the bigger story. Next quarter, Applied Materials guided for $8.95 billion in revenue. Wall Street expected $8.14 billion. The CEO said the company now expects semiconductor equipment business growth of more than 30% this year. 10 quarters in a row of beating estimates. So what does this company actually do? Every AI chip has to be physically built. That requires incredibly specialized tools. Applied Materials make those tools. Once their equipment is built into a chip maker's production process, it stays there. Customers do not swap it out. That creates very predictable revenue. The biggest tech companies in the world are spending hundreds of billions of dollars building out AI infrastructure. That spending flows to chip manufacturers. When chip manufacturers expand capacity, they buy more equipment. Applied Materials sits directly in the path of that spending. Multiple analysts raised price targets this week. Citi to $520, RBC to $500, and Cantor Fitzgerald to $550. Tonight's results give those targets more credibility. Advanced packaging revenue grew 90% year over year. That matters because the memory chips powering NVIDIA's AI systems require more complex manufacturing steps. Applied Material provides equipment for a significant portion of those steps. So the valuation is not cheap. A lot of good news is already priced in. A significant portion of revenue comes from TSMC and Samsung. If either slows spending, Applied Material feels it immediately. China risk is also real. Any escalation in trade tensions or export restrictions could affect the equipment spending cycle quickly. So the question is, would I buy it? Tonight's earnings moved it meaningfully closer to a buy for me. 10 consecutive beats is not luck. The guidance raise tells you management has genuine visibility into demand. And once their equipment is in a chip maker's production process, it stays there. Not many companies can say their customers literally cannot remove them from the production line. But I would not chase it at current after our prices. After a 65% run this year, you are paying for continued flawless execution at this valuation. One disappointing quarter could be painful. If the stock pulls back 10 to 15% from current levels, the risk reward gets much more interesting. The business is as good as it looks tonight. The question is purely entry point for me. It is on my buy list with a price target, and I am not chasing it tonight.